If you live in New York, California, New Jersey, Illinois, or Connecticut, the government handed you a $6,000 tax break, and almost nobody's claiming it. Here's what happened. A single line buried inside a 700-page tax bill quietly quadrupled one of the biggest deductions in the entire tax code. It's called the SALT deduction. And if you're in a high-tax state, this one change could save you thousands. Not hundreds, thousands, every single year. By the end of this video, you'll know exactly how the new $40,000 SALT rule works, whether you qualify, and how to claim up to $6,000 or more in tax savings, step by step. I'm going to give you a 5-step checklist you can screenshot and follow at tax time, plus the exact math to figure out your savings in under 5 minutes. Quick note, I'm not a financial advisor. This isn't personalized advice. It's what the data shows and what the math says. Always do your own homework before making money moves. Now let's start with the basics, because the name sounds intimidating. The concept isn't. SALT stands for state and local taxes. That's it. 4 words. It includes 3 categories of taxes you already pay. First, your state income tax. That's the chunk your state takes from every paycheck. Second, your local property tax. If you own a home, you know this number. It's the bill your county or city sends you. Third, your personal property tax. Some states charge an annual tax on your car, your boat, or other assets you own. You add those 3 numbers up, that total is your SALT. Simple so far, right? Good. Now here's where the story gets interesting. Before 2018, there was no limit on this deduction. None. You paid $30,000 in state and local taxes. You deducted $30,000, you paid $60,000, deducted $60,000. If you itemized your deductions, you got the full benefit. Dollar for dollar, no cap. Then in 2018, the Tax Cuts and Jobs Act changed everything. It slammed a $10,000 cap on the SALT deduction. Overnight, if you lived in a state like New Jersey or California, where your state income tax and property tax alone could easily top $20,000 or $30,000, you lost a massive deduction. And this didn't just affect wealthy people. Homeowners earning $100,000 in states like New York were suddenly losing out on thousands of dollars in deductions they used to claim. And here's the number that should bother you. Before that cap hit, 30% of Americans itemized their deductions. By 2022, that number collapsed to just 9%. Think about that. 21% of the country stopped itemizing. Millions of people who were saving real money on their taxes just gave up. They switched to the standard deduction, not because it was better for them, because the $10,000 cap made itemizing feel pointless. And many of them never switched back, even now, even though the rules just changed dramatically. Because on July 4th, 2025, a new law changed the game. The One Big Beautiful Bill Act quadrupled the SALT cap from $10,000 to $40,000. And this applies right now for tax years 2025 through 2029. You've got a 5-year window to take advantage of this. After 2029, the cap snaps back down to $10,000. This isn't a permanent change, this is a window, and it's wide open right now. So the question is, how do you actually use it? Let's walk through the SALT savings checklist. 5 steps. Screenshot this part. Bookmark the video, you'll want it when tax time comes around. Step 1, add up your SALT. This is where most people get stuck. They don't know their SALT number, they've never added it up, but it's easier than you think. Start with your state income tax. Grab your most recent W-2 and look at box 17. That's your state income tax withheld for the year. If you pay estimated taxes because you're self-employed, add those quarterly payments together instead. Next, pull your property tax bill. If you own a home, your county or city sends you this bill. It might be one payment or it might be split into 2 or 4. Add the whole year together. Finally, check for personal property tax. Not every state charges this, but if yours does, it's usually a flat annual fee on your car or other registered assets. Now add those 3 numbers together. That's your total SALT. Write it down. Let me walk you through a real example so you can see exactly how this works. Meet Sarah. She lives in New Jersey. She earns $120,000 a year at her job. Her state income tax withheld, shown on her W-2 box 17, is $6,500. Her annual property tax on her home is $11,000. And New Jersey charges her $500 a year in personal property tax on her car. Her total SALT, $18,000. Under the old $10,000 cap, Sarah could only deduct $10,000 of that $18,000. $8,000 in real tax deductions, gone, wasted, every year since 2018. But now, under the new $40,000 cap, she deducts the full $18,000. That's $8,000 more in deductions. At a 22% tax bracket, that saves her $1,760. That's real money. That's a vacation. That's 2 months of car payments. And she gets it every year. The cap stays at $40,000. Now imagine someone who pays more in SALT. The savings scale up fast. We'll see that in a few minutes. And coming up in a minute, I'll show you the exact income range where this deduction saves the most and the point where it starts to disappear. But first, let's keep going through the checklist. Step 2, compare your total itemized deductions to the standard deduction. This is the most important step, and it's the step most people skip. Here's the thing about the SALT deduction. You can only claim it if you itemize your deductions. You can't take the standard deduction and the SALT deduction. It's one or the other. So the question becomes, which path saves you more money? For 2025, the standard deduction is $15,750 if you're single. It's $31,500 if you're married filing jointly. Those numbers are your benchmark. Your itemized deductions need to beat those numbers, otherwise you're better off with the standard deduction. So what counts as itemized deductions? 4 main categories. Your SALT, we just calculated that. Your mortgage interest, if you have a home loan. Your charitable donations, anything you gave to qualified nonprofits. And qualifying medical expenses, but only the portion that exceeds 7.5% of your income. Let me show you how this plays out with Sarah. She's got $18,000 in SALT. She also pays $9,000 a year in mortgage interest on her home loan, and she donates $2,000 to charity each year. Her total itemized deductions, $29,000. The standard deduction for a single filer is $15,750. She beats it by over $13,000. That's not even close. She should absolutely itemize. But here's the common mistake most people make, and it's costing millions of people money right now. They assume the standard deduction is always the better deal. It's faster, it's simpler, your tax software defaults to it. And for years, with the $10,000 cap, it usually was the better choice. So people got into the habit. Year after year, they took the standard deduction without thinking about it. But now that the SALT cap is $40,000, the math has completely changed, especially for homeowners in high tax states. If you own a home in New York, New Jersey, California, Connecticut, Illinois, Massachusetts, or Maryland, and you haven't checked your itemized total against the standard deduction recently, you need to do that this year. Because you might have crossed the threshold without realizing it. And every year you take the standard deduction when you should be itemizing, you're handing money back to the IRS. Now here's the part most people skip. Don't skip this. If you haven't compared your itemized total to the standard deduction since 2018, you could have already left money on the table for an entire year. The new $40,000 cap is retroactive to January 1st, 2025. That means it applies to the return you're filing right now, or should be filing this spring. So if you haven't filed your 2025 taxes yet, this is your chance to check. And if you already filed with the standard deduction, you can amend your return. Which brings us to step 3. Step 3, check the income phase out. This is where a lot of people hear phase out and think this must be complicated. It's not. I'll break it down in plain English. The $40,000 cap is available in full to anyone with a modified adjusted gross income of $500,000 or less. If you're married filing separately, the threshold is $250,000. If you earn under $500,000, you get the full cap. No reduction, no tricks. But if your income goes above $500,000, the cap starts shrinking. Here's exactly how it works. For every dollar you earn over $500,000, your SALT cap drops by 30 cents. Let me give you 2 quick examples so you can see the math. Example 1, you earn $530,000. That's $30,000 over the threshold. 30% of $30,000 is $9,000. Your cap drops from $40,000 to $31,000. You still get a big deduction. It's reduced, but it's still triple what the old cap was. Example 2, you earn $600,000. That's $100,000 over the threshold. 30% of $100,000 is $30,000. Your cap drops from $40,000 by $30,000 down to $10,000. At $600,000 and above, you're back to the old cap. No benefit from the increase. But here's the key takeaway for most viewers. If you earn under $500,000, none of this phase out matters to you. You get the full $40,000 cap, period. And that's where most of our audience falls, earning between $75,000 and $400,000, high enough to pay meaningful SALT, low enough to get the full cap. That's the sweet spot. So what about the people who say this is only for rich people? Here's the reality. If you earn $100,000 in New Jersey and own a modest home, you could easily pay $15,000 to $20,000 in state and local taxes. That's well above the old cap, and now you can deduct every dollar of it. This isn't a Hamptons tax break. This is a homeowner in a high-tax state tax break. And if that's you, this matters. And coming up, I'll show you the exact dollar amount most people in these states are overpaying and a 2-minute move you can make this week. But first, let's finish the checklist. Step 4, file Schedule A and claim your SALT deduction. If your itemized deductions beat the standard deduction and you've confirmed you're below the phase-out threshold, you itemize. Schedule A is the IRS form where you list your itemized deductions. It's part of your regular tax return, and every major tax software walks you through it automatically. TurboTax, H&R Block, Free Tax USA, Tax Act, they all have a built-in comparison tool. You punch in your numbers, and the software tells you whether itemizing or the standard deduction saves you more. Now here's a tip that most people miss. You can't deduct both your state income tax and your state sales tax. You have to pick one. Most people choose state income tax because it's higher. But if you live in a state with no income tax, like Texas, Florida, Nevada, Washington, Wyoming, Tennessee, or South Dakota, you can deduct your sales tax instead. And here's why that matters. If you made any big purchases during the year, a new car, major home renovations, expensive appliances, the sales tax on those purchases could add up to thousands of dollars. Combined with your property tax, that could be enough to push you over the standard deduction threshold. Even in a no income tax state, the SALT deduction can still help you. Don't assume it doesn't apply. Now let's bring it home with the final step. Step 5, plan ahead, and because the cap gets slightly higher each year, for 2026, the SALT cap increases by 1%. That brings it from $40,000 to $40,400. The income phase-out threshold bumps up to $505,000. For 2027, it goes to roughly $40,800. For 2028, about $41,200. And for 2029, approximately $41,600. Those are small annual increases, but the big picture is important. You've got 4 more full tax years of this elevated cap. 4 years to save potentially thousands each year. After 2029, the cap drops back to $10,000. That's not speculation, that's written into the law. Unless Congress passes a new bill to extend it, the window closes. So the move for step 5 is this. Don't just itemize once and forget about it. Set a reminder every January. Run the comparison every year. Your income changes, your property taxes change, your mortgage interest changes. What saved you money this year might not next year. And what didn't save you last year might work now. Make it an annual habit. 5 minutes every January could save you thousands. Now I know what some of you are thinking. I don't own a home. Does any of this apply to me? Here's the honest answer. If you're a renter with no property tax bill, the SALT deduction is harder to make work in your favor. Your SALT would be mostly state income tax. And for most renters, that alone won't push you past the standard deduction. But, and this is important, if you live in a very high tax state like California or New York and you earn over $100,000, your state income tax alone could be $8,000 to $10,000. Add in charitable giving and any other itemized deductions, and you might be closer to the threshold than you think. It's tight. But for some higher earning renters in the most expensive states, it could work. The point is, don't assume. Check the numbers. And here's something else to keep in mind for 2026 specifically. If you're filing your 2025 taxes right now this spring, you're filing during the first year the new cap applies. That means your tax preparer might not automatically switch you to itemizing. They might still have you defaulting to the standard deduction from last year. If you use a CPA or a tax preparer, call them and ask one question. Given the new $40,000 SALT cap, should I be itemizing this year? That one question could save you thousands. If you file on your own with software, make sure you're entering all your SALT amounts and letting the software compare. Don't skip past the itemize or standard screen. That's where the savings live. Now let me show you the full savings picture, because I want you to see exactly where you might fall. Let's start with a married couple earning $200,000. They live in New York. They pay $12,000 in state income tax, $14,000 in property tax, and $1,000 in personal property tax. Their total SALT is $27,000. Under the old cap, they could only deduct $10,000. Under the new cap, they deduct the full $27,000. That's $17,000 more in deductions. At a 22% tax bracket, that's $3,740 back in their pocket. Now let's look at a higher earning couple. They earn $350,000. They live in Connecticut. Their combined SALT is $38,000. Property taxes are brutal in Connecticut. Under the old cap, they deducted $10,000. Now they deduct $38,000. That's $28,000 more in deductions. At the 24% bracket, that's $6,720 saved every single year. That's the $6,000 number from the title. And for some people, homeowners in the most expensive parts of New York, New Jersey, or California, the savings could be even higher. Over the 5-year window from 2025 to 2029, that Connecticut couple saves over $33,000 in federal taxes, just from the SALT cap change. That's a down payment on a car. That's a year of college savings. That's real life-changing money from one deduction most people aren't even claiming. Now here's your action item for this week. And I mean this week, not someday, not next tax season, this week. Pull up your 2025 W-2 or your most recent pay stub. Find box 17, your state income tax withheld. Then pull your most recent property tax bill. Add those two numbers together. If that total is above $15,000 and you're single, or above $32,000 and you're married, you should seriously look at itemizing. The SALT deduction alone might push you over the standard deduction threshold. Add in mortgage interest and charitable giving, and you could be well past it. And remember, your tax software does the comparison for you. You don't have to do this by hand. Plug in the numbers and let the software tell you which option saves more. Let me give you the recap. The SALT cap went from $10,000 to $40,000. It's temporary, only through 2029. If you live in a high tax state and you've been taking the standard deduction on autopilot, it's time to run the numbers. The math has changed. For millions of people, itemizing now saves more. And every year you don't check is a year you might be leaving thousands of dollars with the IRS. Money that belongs in your pocket. 5 steps, 5 minutes, potentially thousands in savings. That's the move. Money made simple. If this was useful, you need to see my next video on the $12,500 overtime rule. If you or anyone in your family works overtime, this could be a game changer. I explain exactly how OBIBA works and why high earners use it to slash their tax bill. Link is right here.